Um, so any piece of research also needs motivation. What's the motivation for the research? Well, the motivation here was really the disruption, of course, caused by COVID, and we all know about that. But amongst the money advisors, there was a sense that this disruption was impacting on two things: one, on people's budgets and the way they managed the money and dealt with debt, but also on the relationship between the money advisor and the client, which obviously, as Sean said, MABS has a long history and so on, but a lot of it is sort of in-person dealing, advisor-client, and of course, COVID threw that completely, and we needed to develop new methods of working. So the disruption was sort of both intra-service, if you like, within the MABS client engagement, and also beyond in terms of how clients were managing the money. I think the key thing is that they felt that some people were being affected more than others. And that's really the driver for this research. Who are the people who are more affected in a financial sense by COVID, and how is it playing out in their lives? So the timing of the research, yes, as Sean said, it was conducted last summer, over the summer, and it's in two bits. So the quantitative piece of the research, the statistics, the numbers, which when you're looking at the report is sort of the first bit of the findings. What we were looking at there was the client base between the 13th of March and the 30th of June. Okay, so 13th of March was the date when restrictions started to really kick in, and we went to the end of that quarter, if you like, to the end of June, to look at were there any changes in the client base during those first few months of COVID, and if so, what were those changes and how were they playing out? So it was, if you like, trying to get an initial sense of where problems might be coming down the track and for whom. And then there was a second piece, which is a more qualitative piece, where we asked money advisors across the region. And as I say, we got 50 responses, which was just wonderful. I asked them for their perspectives, their experiences of dealing with clients. As I say, a little bit down the road, that was in September. So at that stage, we were moving towards a gradual reopening. Goodness me, it's been a real roller coaster, hasn't it? I can't remember how many levels we've been through. My brother calls it level 42, which for those of you of a certain musical sort of persuasion, you remember them well. But I can't remember what level we were at actually in September. But what I do know is that I think the timing of the research launch today is actually very good, because we're pretty much where we were sort of 12 months ago, really, in terms of looking at coming through, or looking into the future as far as we can. So just to, I hope that's clear, there's a quantitative piece and there's a qualitative piece to this research. Its objectives, as I say, first we wanted to try and see whether there are any differences in the client base. And I should point out, this is the active client base, the base that money advisors across the region, they were working with clients who were live cases, if you like, at the time. We wanted to look at, were there any changes in terms of people's money management and the way they were budgeting and, as I say, paying and managing money. And also, were there any, COVID had any impacts in terms of the way they were dealing with debt, the debt problems that they had. So those the three objectives, really. But of course, to any research, there's a context. And the context of the research here is really important. So when COVID struck, it didn't find a blank canvas here. There were already a lot of people already in financial difficulty, in trouble. MABS were dealing with a large number of clients in March when COVID and social distancing really struck. And there was also obviously a lot of legacy debts, which we're familiar with, dating back in some cases to the mid-noughties and predating the mortgage arrears crisis. So there are already a large pool of people already in trouble. But more broadly, there are also issues around inequality and poverty in society. And those issues were there before COVID struck. And it's important to recognise that. And inequality and poverty and deprivation and unemployment, all those trends were going in the right direction. They were all coming down, which is good. But they were coming down gradually. And we have to remember that when COVID struck, a large amount of people in Ireland were in poverty, they were in consistent poverty, they were experiencing deprivation, inequality, financial exclusion, and all the rest of it. So that's a very, very important context. And we know that COVID has amplified those inequalities in society. And I know Nessun is going to talk a bit about that. But certainly it's also done so in a personal finance sense. And we're going to talk about that in a second. Of course, a lot of supports were put in place, income supports and household protection supports, which have been very, very important. But for many people, the social distancing that we all sort of, I won't say we take for granted, but we've all sort of become used to, that affected people in different ways, and particularly in a personal financial sense. So of course, there were some people used to paying for things in cash, going to the post office, you know, using in-person methods of bill payment and so on, and even dealing with MABS in that way. And now all of a sudden people were having to move or try and look at alternatives. And of course, for many people, that was quite seamless and they were able to do so. But for others, that presented huge challenges. People who were unbanked or sort of had a preference for use of cash or paying things in person. So it's important just to put the context in there before we get into the findings. I hope that's sort of clear. So of course, COVID strikes and all the supports that we know now put in place very rapidly, really. And of course, and what happened to the cases, and we know this from the MABS data, is in Q2 cases went down from Q1. And that also was the case in terms of live cases as well. Those cases also dropped, although not by as much. But although the cases dropped, what we were looking for was to see were there any particular groups between that March and June period who seemed to be using MABS services slightly more than others. And we identified 5. And they were groups, people in receipt of social welfare, people who are 65 and over, lone parents and single persons, private tenants, and people who were living with friends or family. They were the sort of 5 groups, if you like. And the divergences were small, but they were noticeable. And I think that's important because that tells us where we may find problems occurring down the line amongst groups, perhaps in some cases, people who hadn't experienced debt problems before. And I think the thing that struck, well, certainly the thing that struck me when we were looking at the MABS data, was when you looked at the people that approached MABS in that first quarter after COVID, the March to June period, an awful lot of those people, around 8 in 10, we calculate, were brand new to MABS. In other words, they'd never engaged with MABS at all, as far as we could see before that. And that was quite different to the period leading up to COVID, where an awful lot of people who were live, active MABS clients had actually maybe come and gone a little bit in the past. They'd been a client some years ago, they had the case closed perhaps, and then they'd come back to MABS. So this seemed to be a new cohort of clients. And this very much bears out a lot of the research and the talk at the moment, that when COVID plays out, that we're going to find a lot of people who had never had financial difficulty before in need of help and likely to be approaching MABS services. So that's the sort of quantitative numbers piece. I hope that that makes sense. There's some divergences there, and you could see some trends which I think point to where we might be going in the future. And then we had the qualitative piece to the research. And I think the best way to think about this, and I should say, sorry, a lot of those quantitative findings, the Society of St. Vincent de Paul, which released a piece of research yesterday that many of you will have seen, actually says very similar things, I think, to what we found, which is really interesting because that research was only undertaken, as I understand it, in recent weeks and months. So I think that there's a very interesting sort of corroboration there. So yeah, the qualitative findings, and I think the best way to think of this is to look at sort of 2 sides of a coin. So amongst the MABS client base, there were people who were doing better now financially. And these were generally people who were working, who were in employment, who their costs are cut down because they weren't traveling or they weren't having lunches out or whatever it is. So one group had more disposable income. Some had payment breaks, some had moratoria and so on. But the other side of the coin is the really important side, I think, and the side that really shines through in this research. And that's a group that were doing worse as a result of COVID. Their expenses had gone up, and their incomes obviously were low to start with in many cases. So just to make the point that some people were doing sort of okay, maybe a little bit better at times, but others weren't. And they're the group I want to look at just in the last few minutes of my presentation here. And maybe the way to think about it is to think of the 3 Ps, and I'm going to call them poverty, precarity, and partnership. So if we take poverty first, we know from a body of research that MABS clients in general tend to be on lower incomes than the population at large. So they're already on a low income to start with. So when you add on to low income added expense, and we know from COVID that for a lot of people they're spending more time at home, so they're using more fuel, there's more bodies in the home, perhaps the adult children have come back to the nest, they're consuming more, as we all know. So you end up with not just lower income, but also higher expenses. So that obviously increases poverty, it pushes some people into poverty. But there's another side to poverty, as you all know, which is social exclusion, which is that poverty means you can't participate as much in society as others. You can't sort of do what people do in general. And the social inclusion piece we found is very much linked to the financial exclusion issue, which is people's inability to access and use financial services, banks, credit, insurance, and all the rest of it. But the real issue here we found was that it's people, by and large, for many people, the whole business of information technology, what we're doing this morning through Zoom, many people operating through WhatsApp and email and goodness knows what. And that works for many, many people, and many people adapted very well to COVID as a result and to dealings with personal finances. But for others who were financially excluded, maybe relying on cash, as I say, or in-person sort of transactions, it presented a real difficulty. And there's actually some very interesting examples in the report of really good things that happened. People who became used to dealing with things electronically, people who opened internet banking and got used to it and found it very empowering. So there were some people within, if you like, the excluded group who were able to be brought in to sort of the financially included group, if you like, but not everyone. And it's the people on the margins, by and large, who are marginalised to start with, who have had the most difficulty around this. So that's poverty. And then the next P is precarity. And again, sort of two sides to this particular issue. The first is precarious income. And we know about this, there's been a lot written about people in precarious income, services and so on, construction and all the rest of it, having real difficulties. But I was really struck by an interview Michelle O'Hara gave, regional manager for MABS, on the radio some time ago, where she said, who would have ever thought that an aircraft pilot would be in a precarious income, in precarious work? And I think that was a really powerful example of how COVID has actually blown open this issue of precarious work. There's many more people now in precarious work that we may not have thought of before. But the other side of precarity is in terms of budgets. And there's quite a big piece in the report where we look at the issue, as many of you will recall, when payments, social welfare payments, went from 1 week to 2 weeks. You remember this, many of you. And that, for many people, just threw them completely, threw the budget out. People ran out of money by the end of the second week, often had to go without or cut back. And I think what that tells us is just how precarious many people's budgets are, even when they're involved with MABS. Because at the root of all this, as we've mentioned before, is poverty and inequality and lack of income to start with. So that precarity of budgets, I think, is a very important takeaway from the research. And the third and final sort of set of qualitative findings, I think we could call partnership. And by partnership, I'm talking here about the relationship between money advisors and their clients. And there was an awful lot of concern. You could feel it from some money advisors and not so much from others about how COVID and social distancing had impacted on the relationship between MABS and their clients, which usually, as we know, is often based on in-person contact. It's based on building trust, relationships, and so on. And again, for some clients, this worked well. And we've got several money advisors were talking about how it actually had speeded up the process dealing with things remotely. For many people, it suited them if they were at work, for instance. They were familiar with the whole to and froing of information and communication electronically and remotely. And so for some clients, it worked very, very well. But for others, and particularly clients who were used to dealing with MABS in a particular way, perhaps through a drop-in sort of method, if you like, who really valued the interpersonal contact that they had with the money advisors. Things had changed and it had affected that relationship, and it's becoming more difficult even to do basic things such as get signed authority, and people were becoming frustrated about doing the things which are very easily done when you're working in person. So I hope you're seeing the theme here that actually, there's two sides to this coin. There's different groups. The MABS client base is not a homogenous group. They're not all the same. Some people maybe have done better, at least in the short term, but then there's a lot who have actually been affected quite profoundly, we think. So that's the end of the findings, really. Just a few final comments going forward. Maybe the last examples point a way forward for MABS. Maybe the idea of a twin track sort of approach where some clients you can deal with electronically and remotely, and that works well for them, but then others will still need that in-person sort of support that needs to be provided, I think, going forward, hopefully if and when we come out of the current situation. And the second thing going forward is I think we need to think in general a lot more about people on the margins. We really need to marginalisation proof any measures that we take going forward. And what struck me is that often as a researcher, you come in, you do a piece of research and you go on to the next one. MABS is in a really unique position because money advisors up and down the country are the first, almost like the canaries in the coal mine. They actually hear the issues coming in real time, straight away. And I think we need to try and think about how we can find ways, not just MABS, but the Society of Instapol, Threshold, FLAC, everybody who's working in this sort of space. How can we somehow get together and feed these things in from the ground up much more quickly and regularly, perhaps, than has been done heretofore? And just a final thing to say is there's a lot of talk about the idea of debts being, if you like, incubated at the moment, and that there is going to be, some sort of spike or surge or whatever we like to call it down the road. And I think our research sort of confirms that. And in fact, the MABS data, if you look at what happened in Q3 when society started to open up, and you'll see in the report, which coincided with that period, many advisors were talking about people coming in with disconnection notices, demands for payments and so on. So I think that the numbers, that the change in MABS statistics between Q2 and Q3, I think really gives us, if you like, a portent of what is to come down the road. So I'd like to finish with a couple of well wishes, if I may, Sean, just before I go. First is I'd like to wish Angela well in her forthcoming retirement. My better half took a similar plunge a couple of weeks ago. She's absolutely very, very chilled and relaxed about all of this and enjoying it. So I hope you have a similar experience. We've worked together on many of these launches, Angela, mortgage arrears and traveller issues and illegal money lending, fuel poverty, and now this one on COVID. Angela's always been very supportive of the research that we've done and has got behind the issues that have been raised. So I'd like to thank her for that. I'd say and wish her well into the future. And just finally, I'd like to wish all across the MABS network. I don't quite know who's here participant-wise today, but I'm sure many of you work in MABS up and down the land. But Gwen Harris informed me or reminded me recently that MABS is 30 years old next year, which is quite extraordinary in many ways. And when you think about it, MABS has adapted from money lending, dealing with money lending issues, through to dealing with the personal credit boom in the noughties, to the mortgage arrears crisis beyond, and personal insolvency and so on. And I'm sure, and it is adapting again to COVID, and it will continue to adapt, I'm sure. But I'd like just to wish all of you out there in the field well for the months that are to come, and obviously the dealing with the problems that will emerge. And the final wish, I'm sure you wish me to get off the stage now. You've probably heard enough from me, so I'm going to exit quietly stage left and hand back to Sean. Thanks very much.